Welcome to episode 10 of Real Estate with the Carters. I'm Anneline Carter,
And I'm Christopher Carter.
and together we are the
Carters.
Welcome, everyone. Today we are filming our 10th episode.
Tent.
Yes.
A great milestone, right?
Yes.
All right, so we're on our way to 100.
Oh, yes.
So
So we're
we're
1/10 of the way.
1/10 of the way. Thanks for those who have subscribed, those who have joined us. Please continue to subscribe, share, like, comment.
Yes.
We've gotten some very good feedback.
Yeah, we have. We have from our clients or past clients.
Today we got a text message from one of our clients. He's actually in production, so he gave us some tips about how to
Some
make
great pointers.
how to make the videos a lot, the quality a lot better. And so thank you.
Yes.
You know who you are. Thanks a lot. Just continue to like, subscribe, and share.
Yes,
and we
please.
appreciate all the feedbacks, all the support. We've also started some shorter forms of our videos because
Yes.
you know, a couple of clients have said, "Oh my God, your videos are so long." So we have some shorter videos. We've been posting them since last week. I think we've posted 2 or 3 so far.
Yes.
And
we
so
have.
you can also look forward to see
some
more
shorts,
some more
yeah.
shorter videos.
Okay.
Without further ado, let's just jump into today's topic.
Okay.
What's on the menu for today?
All right. So today's topic, we're going to discuss how you can use the equity in your home to build generational wealth.
Okay,
All right.
so some key points: equity and generational wealth. Right.
Yes.
Over the last 2-3 years, equity in homes have just exploded.
Yeah.
Just exploded.
They have.
You know, persons have seen $300,000 home now valued at $400,000-$600,000,
Most definitely.
and so that equity between what you owe to the lender and what the property value, that difference is what is called equity. But let's give a
I was
definition.
going to say,
of,
you want to talk about what equity is for those who
Right.
don't understand?
All right, so equity is basically the value of your home minus whatever you're owing on it.
Okay.
Right. So say your home values $300,000 and you have a loan balance of about $150.
Okay.
So between 300 and 150,
It's like 150.
that's 150. So that would be considered your equity. Now, like I said, over the last couple of years, we've really seen
A spike.
a spike in equity. Now,
or rise.
equity, and this is something I was discussing recently with one of my clients. So equity is a fictitious, if wanting of a better word, term is so the equity is not stagnant, or so it may be 200,000 today. Tomorrow, if the value increases, it may be 250. But also, if the value
And it
goes down,
drops. Right.
then that equity may go down.
Right.
And you could get to a point where you're upside down and you have negative equity. So equity is at a particular point in time.
Okay. Understood.
Right? So
Understood.
that equity, you can't say equity this year, 250. You still have that equity next year. You may have different valuations. Your loan balance may have changed. So
Right.
just kind of bear that in mind. So we've seen record, as we said, record
high.
In fact, according to Black Knight, 9.9 trillion has been what homeowners currently owns or have in terms of equity since since 2021. They have seen a 2.6 trillion increase in equity.
That's a lot.
So that's a lot of money. So that's a lot of money that is sitting inside the house.
Okay.
Right? Inside your home, that's value. Now they said the average equity on most home is about 185,000.
That's still a good sum of money.
That's a good sum of money that could help in terms of building generation wealth.
Yep.
Now, so
how do you build the equity in your house?
All right, so equity in the house is built up in 2 ways, right? If you have a loan, once you start paying down that loan balance, then obviously whatever the home value minus the loan, seeing that the loan is going down, then more equity, is there that
Right,
can
so
be
the balance
accessed.
of the loan decreases, which increases the equity in your home.
Correct.
Okay.
Also, if the value of the home increases, right?
Right.
So if when you bought the home was 250 or 300,000 value, this home now is 400,000. That also, so so there are two ways generally that you build equity. One is the paying down of the mortgage, and the other is the general increase of the property value.
Okay.
All right. Now, appreciation in home, as let's said, over the last 2-3 years, since 2020, between 40 and 50%, there's been value increase in most properties,
Right.
which is a great number, right? And if properly used, that equity could do a couple of stuff, right?
Right.
It could fund your college funds for your children, right?
Right.
We could use it to consolidate loans. Like if you have high credit card debt, you could use that equity to help to pay off those higher balance loans.
Starting a business.
You
could
can
be one
start
of
a
those
business. You could fund a vacation, pay for a wedding or important celebration.
Right.
You can make improvements or upgrade to the home.
Right.
And you also could pay medical bills, right?
Right.
So the equity in your home can be used for a number
Of different things. Right.
Some of it we consider on the good side.
Right.
Some
but
not.
we're talking about building generational wealth.
Yeah.
We're talking about starting a business,
Correct.
putting your kids in college.
Right. Spending some on yourself, going back to school, just doing stuff that is going to increase either your value or value in a property or in a business.
Correct.
Now, if you take the equity to go on vacations or to go to Louis Vuitton or Chanel or, spend on luxury item, then that could have negative impact on you.
That can also help you build and make you feel better about yourself. I mean,
yes, quite possible.
Help your mental health. Go shopping.
I'm sure you'd find. I'm sure you'd find some pleasure in going.
Definitely going on vacation is helping my mental health.
Okay. Now, so let's talk about some ways that we could pull
the
some
equity
of that
from out of the
equity.
home.
Give you just a quick joke. So one time a client said to me, I went to the bank and tell them that I have equity in my house and I want to take out some. But her thought process was she could just tell the bank that she has the equity and they would just write her a check.
Oh, it's not that easy.
I'd give her whatever she thinks that equity is. Unfortunately, that's not how that works. So equity could be taken out in a couple of ways, right?
All right, so
you could do an ELOC, right, which is an home equity line of credit, and that is borrowing against equity. So you could go to your bank, your credit union, to a mortgage broker and say, hey, I want to do an ELOC. Obviously, they'll ask you the value. They also check that you can afford to pay for the existing mortgage along with the ELOC. But once you're able to qualify and there's enough equity that allows you to take some out, definitely you can do an ELOC, right? You can do an E-loan, which is an ELOC is a line of credit, right? So you could get an ELOC for say 100,000, but you may not take the exact 100,000 out at one time. You may take out 10, and then at different juncture based on your needs, based on the demand, you may take out some.
Right.
So the difference between an ELOC and an E-loan is a fixed amount.
Okay, so you get like a lump sum.
You get a lump sum up front, so you get 50,000, and you start paying on that 50,000 the moment it's dispersed.
All right.
On an ELOC,
there's interest rates that are attached to both of these.
Correct. Now, the good thing of doing an ELOC or an E-loan is that you don't affect your existing mortgage.
Okay.
So if you have a mortgage, say at 3, at 2.75, at 4% rate, taking an ELOC and an E-loan is in addition to
that. Right. So the bank is going to look at that. You can afford like you
both.
Said, both. Okay.
But you're not closing out your existing loan that may have a 2% or a 3% interest rate.
Okay.
Bear in mind, though, that the interest rate on an e-lock and e-loan, especially now, could be significantly higher than the rate that you have
for
on
the
your
mortgage.
general mortgage, right?
Okay.
But that's something that you would discuss with your lender, either through your credit union, your mortgage broker, your local bank. That's something you discuss with them prior to you taking those out.
Okay.
Another way of taking money from the property or accessing your equity is doing a cash out refinance.
Okay.
So this is separate and this is quite different from an
A
e-lock
HELOC.
or e-loan in that you'll be refinancing the entire
The
loan, existing mortgage, right? So it's a new loan that takes into consideration what you owe and it's going to refinance that into a new loan.
Okay.
Some of the drawback is obviously if you have a mortgage that was at a 2% rate and now the rates are 7.5, the new loan is going to be at 7.5, right? So that's kind of one of the drawback of doing a refinance, cash out refinance, as
especially in today's market.
Right. The rates are a little high now. So obviously you want to kind of look at your, there's different circumstances. Now,
but it's still a good tool to use,
correct,
depending on where the interest rate is.
And you need, because it's obviously going to come down to, do I need this money? Or if I take this money, can I do something with it that is going to bring more revenue to pay the existing loan and to put money in my pocket?
Okay.
So if you're taking it out, say, to buy an investment property or to invest in a business or to go back to school, the interest rate would possibly not be the main reason. Because the interest rate, whatever you're doing with it is going to give you back more.
Return,
right? The return is going to be greater than the cost.
Right.
Another way of accessing your equity is what I call the final way, which is selling the property.
Okay.
Right? Because if you bought a property, say for $200,000, it's now valued $400,000, you owe $150,000. Obviously, if you sell it, you're going to get $400,000 less whatever fees associated with selling that property. So that's the more final way of doing this. Obviously, if you do it this way, if you sell the property, you no longer have the property. Right? And so the question you're going to ask yourself is, do I want to get rid of this property? Could I get rid of this property, pay off the mortgage, and then use the money to do something else?
Okay.
You may be moving out of state, right? You may be, just going into a different phase, getting a divorce. There could be reasons why you want to do.
So you have to look at what your need is.
Correct. So your current situation is going to be determine. A main factor in determining, what part of your, what's your action, your action is going to be based on the different options. So we have an e-lock, an e-loan, a cash out refinance, and the main one, or the last one, is selling the equity.
Okay.
Now, if for any reason you're thinking of taking out or accessing your equity, you have to kind of always ask yourself two questions. The first thing is why? Why am I doing this? Right? And if that answer is a positive, then the next question is, what are my options? Right? And again, the options are, very straightforward: an e-lock, an e-loan, a cash out refinance, or you can ultimately sell the property. We're going to take a quick break.
Okay.
We're going to be back shortly, where we go into how we can use this equity to build generational wealth. Join us back.
All right. See you soon.
See you soon.
Life is full of challenging decisions. Finding the right mortgage company should not be one of them. We at Loans Hub Mortgage and Finance are leaders in residential mortgages, refinancing, and investment property financing. We have a loan solution for your every need. Call us today at 954-947-8662, or you can find us online at www.loanshublending.com. Your next approval is just a phone call away. Loans Hub is an equal housing lender, NMLS 2220747. Welcome back to episode 10 of Real Estate with the Carters. I'm Anneline Carter.
And I'm Christopher Carter.
All right. In this next segment, we're going to discuss now how you can build generation wealth using the equity in your home.
Okay,
Right?
perfect. So,
Okay.
all right, so let's talk about, previously we discussed what is equity, right? And how do you determine the equity in your home? Now,
And
on
different
this-
ways that you can.
different ways that we
you
can
can pull out the
actually
equity.
pull that equity, right? So we discussed that in the earlier segment,
Yes.
right?
All right.
So now what we're going to be jumping to now is how can we build generational wealth using this equity? Now, the first word that comes to mind when you talk about generational wealth is invest.
Yes.
Investment,
Yes.
right?
Invest in real estate, with the
Right.
stock market.
Correct.
Right.
So let's jump into the main way that you're going to build generational wealth with equity is by investing, using pulling that money out either through an e-lock, an e-loan, a cash out refinance, or ultimately selling the property. And once you have that money, how do you use that money to, as we say in Jamaica, turn that money around
Keep
over
turning
and
it
over, keep
over
turning
and
it
over
over
and
and over
over
and
again.
over to build generational wealth. So the first thing that, as we said, is investment, right? And then under investment, we have a couple of ways of how we can invest. The first one is invest in real estate, right?
Right.
So we can buy multiple
properties.
rental properties, rent them out, manage those properties, collect the rent, and just keep doing that.
Right. Or even
Right.
buying a property and flipping it.
Or we
Also.
can, right, you can, so real estate. So either buying and holding or flipping, you can build wealth through real estate.
Real estate.
Right.
Right. Agree.
It comes down to being able to assess, buying those investment properties. How do you determine? Now we did an earlier video. I think this was week 2 or 3,
We
or
did
episode 2 or
about
3,
and
where we talk about how to
purchasing
assess
investment properties.
investment
real
property.
estate. Right.
Right. And so if that's that channel that you want to go through in terms of buying investment property, you have to understand how to assess investment property, make sure that you're not, throwing the money away, but you're making prudent, very, very strong decisions in terms of, what you're
So you
buying.
can make a return on it. Your investment.
Obviously, you're making positive return on the investment. All
Right.
right. So that's one way of looking at it.
Right. Another thing is that we can start a business.
Right. So just going back to finishing up invest. So we can buy to old, which is buying investment property, or we can get into the flipping game where we buy a property, property that is at a depreciated value in terms of the property is not need some work. So it's not, it's not moving ready, but it may require some rehab, right? So we could buy those properties and we could
Do
fix them
rehab,
up,
and
we
sell them
could
at market
sell
value.
them back at market value, and make some money doing that. You wanna, obviously, that is going to be a lot more detailed, right?
Okay.
Because now you're gonna be getting contractors, permits, and different aspect of building involved. So you definitely want to have an idea, a good understanding of how to get into that realm. You may also want to partner with somebody who has some experience
Right.
doing flips and just understanding the nature of what to look for, what are some of the issues that are going to come up. Because when you buy that property and say you buy for $200,000, you want that property to, after you've put another 100,000, that's 300,000 you're in. You want to make sure that when you sell it, you're not only recovering what you put in it and what you bought it for, but you're making some money doing that. So that's something that is going to take a lot more interaction within that process. So you definitely want to get some experience or work with people that has experience doing flips.
Okay.
All right. Now, another way of building generational wealth is
Starting a business.
starting a business.
Right.
And to be honest, especially in Florida, there's so many small businesses, right? But there's also so many small businesses that are doing extremely well. Again, it's how do you pick the right business venture to go into? Is it something that you're familiar with? Is something that you say you have a 9 to 5 job and you're doing something that is related to your 9 to 5 job? For instance,
Like
you
you're
could
freelancing.
work in an accounting firm and then on the weekends you do tax. You set up a tax business. Or you could, do transportation, like buy a car to drive Uber or, something you
Or
could
you enjoy
start.
cooking and you start, doing like
Correct.
meal planner, meal prep on the side, or
Correct.
even have a food truck, which is very popular nowadays.
Correct.
So,
Right.
those are things that you
Right.
can do to start a business. You
Start
have a
the
hobby
business,
that you
right.
something that you love doing. Say you start a business.
Could start a
doing your
YouTube
business.
channel. Right.
Right.
Right. The thing though, again, is assessing, do I have enough knowledge of this business, whatever the business venture is? Do I know enough about it to invest in it? Again, your idea of investing is you want to build generational wealth.
Right.
You're not trying to throw your money away. So you want to make sure that whatever business idea you come up with, it can make money. Right?
Agree.
And you understand it to the level that you can take it not just on the surface, but you can take it to the next level, right? So you definitely want to do some research, talk to people who's in that industry, go out, meet clients, do your market research, have your business plan, find out, the cost for material, the cost for whatever you need to be doing. Make sure you do that due diligence up front before you start putting money in it, right? Because again, the aim is to build generational wealth, not waste this money, right? A third way is
Investing in the stock market.
the stock market, right?
You
So that's
dabbled in the
another
stock
way of
market
investment.
A little bit, so you can talk a bit. I said you dabbled in the stock market, so you can talk to them about
Again,
that.
it's a great way of making money, but it's a very easy way of losing money. Whatever the idea is, whether it's a business, whether it's real estate, whether it's stock,
You just gotta do your
you
research.
definitely have to
gotta
do your
the research.
due diligence. You have to do your research. I can't stress that enough. Not because John is doing okay or John is doing great mean you're going to do great. You have to understand what John is doing and don't necessarily replicate, but understand what he's doing and be able to use what he's doing to your benefit.
Okay.
You have to read. You have to watch YouTube channels. Watch
Take classes.
May go back to school. Whatever you need to do, you have to make sure you have that requisite knowledge so that you can make this venture successful.
Agree.
Stock market is it goes up and down. Going to come down to, are you trying to do day trading? Are you going to be buying stock for the long haul? Are you going to be buying blue chip stock? Are you going to be buying penny stock? So there's so much to understand and to learn about the stock market that if you're going to pull equity from your home to invest in the stock market, you definitely either you go through an investment advisor who knows what they're doing, if and can invest that money for you, or if you're going to be doing it yourself, you definitely want to make sure that you do your due diligence. You do your reading, you do your educational process first before you start putting money out. All right?
Okay.
A next way of building generational wealth through the equity
is investing in yourself. Well, in yourself and your family.
Right, and that is
the ways like going back to school.
Getting
putting
a degree.
Your children through college.
Getting a degree, just doing something that is going to bring you to a point where you can, with your family, your earning power. For instance, if you're in IT, you could go get some accreditation.
Okay.
Right? You could get a degree. You could get a master's degree. You could. There's so much you can do. The thing though is, you wanna make sure that investment is something that is going to make money at the end. Right?
Okay.
So if you're a nurse,
elevate you.
elevate you to the next level, that your earning power is going to be
more.
so much greater that you're able to pay back this loan and still, make a good living. But I couldn't stress it enough that investing in yourself or in your kids, your family, is easily going to be paid off once you guys, invest in something that serves a while.
Okay.
Right? Like for me, I'm a prime example. I went back, I did my degree, I did my master's. At one time, I was Series 7. I did my mortgage license, I did my real estate license. I've always invested in myself. And by investing in myself, I'm able to invest in my kids and my family. Right? So I definitely would implore persons, if that's an option for you, then just make sure that you're going down the right path.
Okay.
And you could also start a new career, right?
Right.
You could use that equity to help you to get into something new. Like I remember one of our clients, I won't call his name now, but he bought a truck
Right.
and went into trucking, right? He was a mechanic previously, but he decided that he wanted to
do something else.
get into something new, and he
Right.
bought a truck,
And he's doing pretty well.
and it's doing pretty well. So again, you have to just understand what it is that you want to do, and you have to do your research, get all the questions that you have, get them answered. And once you're at a point where you feel like you have enough information, then you want to step forward.
Definitely.
But don't move forward unless you have enough information, enough knowledge on whatever you're trying to do before you make those decisions to move forward. All right?
Definitely.
Now, what should you consider before pulling
Out the equity in your
pulling
home.
your equity in your home? And we talk a little
talked
bit
a little
about
bit.
some of them, but
We
we just
did.
kind of wanted to dive a little deeper into some of the issues. The first main one,
Is it, can you afford to make the new payments? Right?
can you
Because,
afford to make this new payment?
Because, like you
right?
said, it's almost like a loan that you're getting.
It's not almost like
It's a loan. It's a loan
loan
that you're getting.
right,
So whether
right.
it's a
Unless
it's
you
a-
sell the property and you
Right.
have that money now.
So whether you're getting a HELOC or
Right.
you're getting a HE
HE
loan
loan,
or you're
right.
going to do a refinance, right?
It's
you
a
have
loan.
to
It's a
determine
loan.
whether or not you can afford the new
The
payments that
new
you're going to
payment,
have.
definitely.
Right?
And you definitely want to look at all your options before. You want to make sure that you understand the nature of what you're doing, one, and two, you talk to someone in finance, either your mortgage broker, your lender, whoever is going to be doing this transaction. You want to look at your different options, whether or not it's an HELOC, an E-loan, a refinance. You definitely want to have them run the numbers and make sure that whichever one you're making, whichever
Right.
decision you're making, then the payment is something that you can afford.
Can afford to make.
Right? Because then you may run in some trouble later
on.
if you're not able to make those payments on time.
Okay.
Do I understand what I'm investing in? And we talk a lot about that in the earlier segment. Is you have to make sure that if you're going to be using this money to invest, either you invest in real estate, in a business,
In the stock
stock
market.
market, whatever you're investing in, you definitely want to ensure that you have a good grasp of the ins and outs of that business.
Okay.
Right? Because
Understood.
again, once you put your money in, if you make bad decisions, you may not be able to get any money back, and then because it's a loan and you have to repay it, then you
gotta
may
make
be
sure that you have
forced.
to.
You may be forced by the bank to make decisions that you did not want to make.
All right, I agree.
Another thing
Thing
to
to
consider is what are the tax implications of pulling the equity.
All right.
Right? And then not just a tax implication of pulling the equity, but if you invest, what you invest in, what are the tax implication of those investments? Right? Because those, the money you earn from those investments, depending on the nature of the kind of investment, you may have to pay taxes on them. And you have to kind of understand now, how does that affect your tax situation?
Right.
Right?
All right. And then also another factor is that if you do take out a home equity, would that put you in a position to lose your home, right? If you
Definitely.
don't pay back that
Correct.
money, right?
And that's definitely the main thing you want to
Like
definitely want to
you need to find
consider.
out from the
What
lender,
right?
right?
What's the implication if
Patient.
I don't pay this loan back? And so you definitely want to have an understanding of what the numbers are up front. You know, God forbid you invest in a business that didn't materialize. Am I able to make this payment?
Right.
And if not, what are my options?
Right.
Right? You definitely want to make sure that you have a good understanding of, you know, what you're doing before you start, you know, taking.
I have a question then. Wouldn't, before the bank say decide to lend you that money, right? Whether it's a HELOC or HE loan, wouldn't they still have to look at your income and what your
Right.
debts are to
Right.
see if lending you this money is, I guess not necessarily benefit them, or they're gonna put you in a position where you again can't pay this money back.
Obviously, they're
Right.
going to assess you, but again, you may take out this money with the idea that I may be starting a business.
Right.
So instead of working 80 hours, I may cut my hours and put some more time in this business, hoping that this business is going to materialize and start making some money. Now, if I cut my hours, obviously my pay is going to be less. And if there's no money coming back on the side of the business, then that could put me in deep
You're aware.
waters,
You're
right?
being right.
So it's really to understand the nature of what you're trying to do.
Okay.
Make sure you have all your ducks in a row, as we say. And so that as when you step out and start making those decisions, you're not making decisions blindly, but you're able to nobody can predict what the future is going to be. And so even sometimes the more soundproof decisions that we make, they may turn out on the opposite side sometime down the road. But again, as I always tell people, 99.9% of my decisions are made on the financial side.
Right.
Show me the money, right?
Right.
Let me see this in black and white. Let me see this on paper, and if on paper it works on paper, then I go with it.
Okay.
You know, gut feelings and someone giving me an idea may sound good, but when you put it on paper and you look at the numbers, it may not make sense.
Okay.
And you definitely want to make sure you're making sound decisions that are not going to put you in financial ruin.
I guess what I was trying to say is that trying to figure out how much money you can borrow. Like, are they going to look at, would this be a risk, for them lending you this?
They are, but
right.
once you're able to afford it, then they're going to lend you.
Yeah. Okay.
Right.
But like
once
you're saying,
they run
you're
your
not sure.
they're going to run their numbers and they're going to say, okay, based on your income, this is what we'll feel comfortable lending you. And then once they lend you what they think they're comfortable lending you, then it's up to you to do whatever you want to do with that money. Right. But if you don't do what you should be doing with that money, and then that loan now becomes a burden to you, then you could find yourself in a situation
where you lose your home.
Right. And the aim is not to lose our home. The aim is to build generational wealth. So we want to make sure before we do anything, we have a good grasp of, the numbers.
Right.
What is this? What does entail in this decision, and what are the positive and the negative, and make sure the positive vastly outweighs the negative.
All right. True.
All right?
I agree.
The how much can I borrow is going to be determined by the value of your property, and most banks lend up to 80% on a cash out.
Okay.
So, say your property value is 400,000. 80% of 400,000 is what you're gonna be borrowing.
Okay.
Now they're gonna take away whatever you owe on that property. So, 400,000, the 80% of 400,000, and say you have a loan of 150, they're gonna minus the loan, and then that difference is what you're able to borrow. Now, are they gonna give you the entire equity? No, it's gonna be based on what you can afford, based on your ability to to
Pay
pay
them.
to pay this loan. They're going to assess your income, whether it's your W-2 pay stubs, 1099 income, whether it's your income from, like, say, investments, income from whatever your income
From
source is. They're going to assess that, and then based on that, they're going to determine what they they can afford to lend you. Again, the aim of doing this is building generational wealth, and you want to build generational wealth by making sound financial decisions. You don't want to be taking out this money to go put in pyramid schemes and that kind of stuff. No, that's not how you build generational wealth. Build generational wealth again by making sound financial
Good decision.
decisions. Right
Okay.
now, we've come to the end
And yeah,
of today's show. Let's kind of run
I'm gonna
over
do a recap.
a recap of what we went through.
Okay. All right. So in closing, again, this discussion was how to use the equity in your home to build generational wealth. So one of the first things that what we talked about was doing an investment, right? Whether you invest in real estate, whether you invest in the stock market, whether you invest in your family or yourself, right? Those and invest in the money that you take out of the property, the equity in yourself, in real estate or the stock market is one way that you can definitely build generational wealth.
Definitely.
Right?
We also looked at some of the way of accessing that equity. We spoke on an e-loan and e-lock, refinance, doing a cash out refinancing, or ultimately selling the property. So those are the main ways that you can, pull money out of that property.
And we're also discussed that there's a downside too and pulling out the equity of your home. So
Right.
you potentially could lose your home, right? You can with the equity you can owe more than the home is actually worth, right?
Right,
So that's a
right.
downside, right?
Right,
And
right.
also it's a longer when you're applying for like a I guess a HELOC or home cash out or whatever, the application process is a lot longer, right?
Right, and
Than when
there's
you
costs.
and there's costs that's
There's
related
costs
to it. So those are things
associated.
that you have
Right.
to determine before
Right.
you can decide whether you want to take out the equity in your home.
Right. So you have to assess what are the costs and then the payment associated with. 'Cause either you're doing an e-lock and e-loan, which is a new loan in addition to your mortgage, or you're going to refinance the entire mortgage, do a cash out and take out a lump sum.
Okay.
Whatever decision or whatever options you choose, there's going to be some costs associated with it. So
Right.
you definitely want to assess whatever that cost is and to make sure that you take that into consideration when making that decision. And the last or final thing that we said, we're saying, or we discussed, is you should not use this equity for frivolous spending. No Louis Vuitton,
Why do you
no
keep saying that?
no
No.
Chanel. No, that's not the generational wealth that we're talking about. The generational wealth that we're talking about is investing, making sound financial investment decisions, right? Decision that is going to not only help you but your family and build generational wealth for your generations to come.
Okay.
All right, so this has brought us to the end of our show. Thanks a lot for tuning in. Thanks a lot again for all who have subscribed. Please continue. Please like and share. Get your friends to subscribe, to comment.
Yeah, share
If you have questions,
videos. Yeah.
right? If you have questions, you can reach out to us. Let's give some numbers.
All right. So my cell phone number is 786-214-1436. You can always reach me there, or you can email me at annelinebrealestate@gmail.com.
All right. And my number is 786-985-1383. Again, it's 786-985-1383. Any question regarding mortgage, then, I'm the person you call. If it's regarding real estate, if you're looking to buy, rent, sell, then you can always call Anneline. I'm the person that does the mortgage related.
The numbers guy.
All right. So please continue to like, share, and subscribe. Turn on your notification bell that you get an alert whenever we upload
Upload our videos.
a new video. Leave your comment.
Yes. And thank you for your support, guys. We really appreciate it. And thank you for the feedback that we've been getting from our friends and clients. Definitely appreciate it.
So have yourself a wonderful, wonderful week.
Yes. And see you soon.
See you next week with episode 11 on Real Estate with a Carters.
Bye for now.
Bye for now.